we're going to make a base case here for why lower interest rates are going to be required for us to see inflation reach the Federal Reserve's goal of 2%. And we talk about it a lot. So today, we're going to get into what I call the shelter inflation bottleneck. That's what we have in front of us here. I'm going to tell buyers and sellers some quick tips and ways that we can manage ourselves here into the summer market to get the most out of our experience. Because I believe that there will be a lot more chaos, volatility, and things going on. So what I didn't cover on the last episode to update us over the past 2 weeks of information and of things that are obviously going to be affecting mortgage interest rates and the real estate market. Well, I didn't talk about the Fed at all because it wasn't worth much talking about. The Fed did not move their interest rate. This was expected. But when we look afterward, we did have Fed Chair Jerome Powell. He had to testify in front of Congress. And when he testified, he did leave the door open. He didn't make any commitments to further rate cuts. He kept his narrative consistent. They're staying data dependent. They want to see what happens with inflation for us to make a decision. That's, his words. For before they make a decision on continued easing of their monetary policy, they need to see further improvement on inflation and a stable job market. We can't forget that. But when pressed, he did not close the door to a rate cut in September. And he also did not close the door for a rate cut in July. So we're going to see what that looks like. Most expectations right now are not for a rate cut in July, but that narrative shifts and does change. And the important thing to note right now is that the Federal Reserve is comprised of Fed members, and there is some dissonance among the members. There are some Fed members that are in favor of 2 cuts this year and a cut earlier. There's one or two Fed members that are in the middle. And then there's a few Fed members that are staunchly opposed to a Fed rate cut until they see a little bit more stability in prices, inflation cooling a little bit more, and stable job market. This is indicative to us that really the market now can speculate as much as it wants, and that creates more volatility. The good news is the volatility that we've experienced year to date here has luckily kept us within a tighter range than what we've had to pallet over the past 2.5 to 3 years. So we're in better shape now, thankfully, because we haven't been seeing the interest rates swing from, 6.8% to 7.5% in a matter of a month and shock the market. People pull their listings, buyers get out of the market and priced out. We haven't seen that here in 2025. We're almost halfway through the year now. So that's good news. That is to set the stage for the argument that I'd like to make. I had a conversation with a very good friend of mine, Phil. Shout out to you, Phil. And I came into the office one day. I was like, Phil, I'm looking at the data, and this just doesn't make sense to me. I'm like, I got the feeling that this whole conversation about inflation and people waiting for rate cuts is us chasing our tail. And it's because how we're looking at the data, which is driving the decision-making process, and the data itself is weighted. And what I mean by that is, well, how much it costs to live in a home is a component of inflation. That's called shelter cost. There's owner's equivalent of rent. So that means, it's really based on rental, what the rental cost is for housing in different markets throughout the country. And then they calculate what the equivalent is when you own a home. So when you take all that into account, the current cost of financing, mortgage rates, is part of that. So if the cost to purchase a home goes up because of the financing cost, the owner's equivalent to rent now goes up, and now that creates a higher shelter component. And we talk about inflation reports, and I know we're getting very markety, but this is important. I want to kind of tease this out. So I'm talking to Phil about this, right? And then I'm like, yeah, man, I think we're at a point where if you look at the data, 35% of the consumer price index, which is one of the inflation measures, and that's one of the ones that's most commonly referred to, well, 35% of that is shelter. You mean to tell me then that there's an expectation that 65% of what the prices for inflation, needs to improve and get us down to 2%. But if the shelter component's above that, it actually needs to really go into a de-inflationary. It has to disinflate so that it can accommodate, because the shelter component moves slowly. It does not move quickly. So here's some of the numbers for that. In May, we got the CPI numbers. The inflation was at 2.4% year over year. Core, 2.8%. Core, again, takes out the volatile elements like food and energy. Shelter index, rent plus the owner's equivalent of rent, rose 0.3% month over month and 3.9% year over year. That contributed to 60% of the CPI for that reading. So it's 35% of the weighting, but it accommodated 60% of that whole inflation reading. So it means that it's overinflation, and the improvement on inflation of everything else, durable goods, services, whatever you want to take a look at, had accommodated that. Over the past 16 months, shelter inflation eased by 0.5%. 0.5 percentage points. So from 4.4% to 3.9%, which was the last reading in May. So over that time, we're not seeing inflation improve. As you know, it's not cooling for shelter as quickly or moving as much as the other components. Brings me to my next point. A Fed rate cut is going to be necessary for us to see the Fed reach its own goal of 2% inflation. This is number one, because I only did a 16-month look back for this, and that's the best 16 months that we can look at as far as inflation improving. There was a big drop a little bit outside of that. That's an anomaly. This is the environment that we've seen that's been a little bit more stable over the past 16 months. The Fed will need to actually lower interest rates to reach 2%. Otherwise, they are not going to. If we get another CPI report and shelter is yet again 50 to 60% of what that total inflation reading is, I mean, every time we see that now, the bell should go off. They need to cut the rate in order for them to reach their own goal. The tight rental markets are part of the cause for this, because with no inventory to buy, people are renting. The rent prices, then they get to kind of set their own price for that, and that creates higher cost for the end tenant. So a rate cut lock-in effect is going to persist because of those 3 to 4% interest rates that we saw prior to the pandemic. So until we see interest rates reach a point where someone can have a palatable interest rate going from 4% up. Now, another component to this is the fact that a lot of people have tapped into home equity. They've taken out second mortgages, HELOCs, second mortgages, which are closed end. They also are called equity loans. A lot of people have done that. So that changes their equity position when they're going to buy something. And that also changes what their overall blended cost of financing for their home is. So, if you have a 4% interest rate on the first mortgage with a $300,000 balance, but you took out a $200,000 home equity line of credit with an interest rate of 8.5%, you can blend those two numbers together, and that number's higher than 4%, based on that, above 6%. So when you compare that, if you go buy another house, if you're below 6%, or you can get there, you're making out better, actually, than what your current financing costs look like. That goes to show that the Federal Reserve needs to lower the interest rate to reach their own target.